Do you know the impact of interest rates on your stock portfolio? Whether it's going up or down, it can have a big effect on your investment portfolio, and that's what we're going to be breaking down in today's video. Now, when you think of a change in interest rates, it can affect both stocks and bonds. So regardless of what you're really invested in, it can have a big change in the way that it is. And looking at the wider business world, a change can affect the behaviors of companies, which again is kind of what we're breaking down here. For stock investors, highest interest rates mean cutting back on spending. This is where we see a lot of layoffs. This is where we see a lot of spending really pulled back or cut back. Meanwhile, as the Fed going into 2025 is saying that interest rates are going to fall, this will encourage larger companies to have bigger purchases, more consumer and expenditures really for business. And it can also change how corporate profits look for better or worse, depending which way it goes. Now, we know looking forward at the artificial intelligence in that space, for a lot of companies that are interested in getting into artificial intelligence, when the rates start going down, it is going to make it a lot cheaper to borrow money. That way they can go ahead and do these corporate expenditures and really build the business. For the bond side of it, interest rates mean that higher rates on new bonds issued, but as it declines, the value of new bonds that are issued is much lower. Lower interest rates do have the opposite effect. New bonds that are issued are going to be much lower, meaning the bonds that people currently own at a higher rate are going to pay a higher yield of return. So when we think of Warren Buffett and put, billions of dollars into bonds right now, as soon as those bonds come due, the new bonds that are issued are going to be a lot lower rate, meaning that he is not going to get as much of a return and people will look for other places to get the money. So of course, all of this hinges on the number one most important thing that we have is the Fed's fund rate. Now the Federal Reserve, the national central bank, changes target interest rates to keep the economy at a healthy level. It raises rates when the economy is too hot, which we've seen over the last 2 years. We have seen the largest, fastest rate increase in history. When you look at graphs, when you start looking at how fast rates went up in such a short amount of time, it was kind of crazy because of rising inflation. And I believe it topped out about 8.6% for inflation. And as the number came back recently, it's about 2.1. Now the Fed manipulates the overall interest rates by lowering or raising these Fed's fund rate, and it ripples through economy. Now the big thing to remember, when the Feds change rates, for instance, last month they went down, or back in, I believe it was September now, might have been September, they did a 50 basis points or 0.50 reduction of the rate. It takes at least 12 months for the widespread effect of that economic change to be seen. That is the reason why a lot of people were kind of wondering and questioning with raising rates so high so fast, if it was going to be a hard landing, if we were going to see a crash, if it was going to be a recession. But overall, seems like it has been pretty good. Overall, we're starting to see prices come down. We're starting to see rates coming down. So it is pretty interesting. So how does it affect your spending? This is another big part. When you think of interest rates, you are essentially raising rates and making everything more expensive, meaning that money is more expensive. If you've seen and have credit card debt, credit card rates have increased. If you wanted to get an auto loan, a mortgage, rates are much higher than we've seen. Going back to 2022, auto loan rates were roughly about 2%. Right now, they're running about 6%. So you can see we're almost a 3x higher in interest rate, which can add hundreds of dollars to any big purchases you're making, especially when it comes to houses and cars. Now, when it comes to business spending, that exactly is the same. When it comes to businesses, when it comes to farmers, when it comes to anyone who has to borrow money, if the rates are high, the money is a lot more expensive. As rates continue to decline, it gets a lot cheaper. And overall, it is the cyclical economy that we see in the productivity and really it increases as an economy. We start building and growing a lot more. Higher interest rates focus on those cutbacks. So what is the impact on stock portfolios? This is very important. If you're an investor like me, if you're an avid investor, it is important. When stocks or when interest rates rise, it makes it a lot more expensive for companies to raise capital, to get money. They have to pay a higher interest rate for bonds that they issue if they're getting bonds. And of course, making it more expensive. Again, we see the cutbacks, we see the layoffs. It can really hurt the company's future growth and also the earnings. The earnings are another big thing, which this is honestly probably one point in history where we have seen interest rates go up and a lot of people continued spending, continued supplementing that income with credit cards, continued spending. But as the rate increases, it could really cause a revision of really the profitability of companies. Now, of course, as we're getting into a interest rate reduction environment, if a company sees that, the rates are coming down, it can be more profitable, it can borrow more money. They want to and don't want to carry as much debt when it's more expensive. But of course, like I said, on the opposite side, when money is fairly cheap, they can go ahead and borrow and have a much higher borrowing power. Now, for this one, we want to talk about the S&P 500. So Goldman Sachs came out with an article, said they're expecting, I believe it was a 1 to 6% growth of the S&P 500 over the next 10 years. And if you look at the last 12 months, we're about 30% in the last 12 months, which is kind of crazy because if enough companies experience declines in their stock prices from these raising rates, it essentially will bring down the entire market. This is the reason why I stress buying ETFs. This is the reason why I stress on really mitigating your risk across the entire market itself. That is why I like the VUG, which is the Vanguard Growth Fund, the S&P 500, the HD. Knowing them and knowing where we are headed right now, it could be a time, even though they are at record highs, we could see them go much higher next year, depending on where the Fed continues to lower rates. If we see, and I believe they were saying 7 rate reductions, then it went to 5, then it went to 3, then it went to 1, which was the forecast for this year. Next year, we're already looking at 5 to 7 rate reductions. Don't know exactly what's going to play out. If I had a crystal ball, it would be absolutely perfect. But I feel like as rates continue to go down and it makes funds a lot more cheaper, essentially for companies to use, that a lot more companies will be starting to make corporate expenditures and start spending money. What is the impact on bonds? This is the other part. When you think of the bond prices, it has an inverse relationship between the bond prices and interest rates. So where you think when it gets cheaper, the stocks go up, companies can spend more, the profitability goes up, it's cheaper to borrow money. The bonds have the opposite mark, where if the rates start going down, the newer issued bonds are going to be much more cheaper than the older bonds. So in a rate reduction environment, really buying bonds at a higher rate is almost like locking in a CD. And that's kind of where I think of it. When you think of a bond or when you think of a CD, if I put $1,000 in a CD right now at 5%, and then I have it for, let's say, the next 12 months, just like buying a 12-month bond, at the end of those 12 months, my 5%, all of a sudden that same 12-month bond is 2.5%. It has lost 50% essentially of the value, but I got to have a place to put it. That's where I feel like a lot of people are going to be stuck. Where a lot of people moved money to bonds, they moved money to these high yield savings accounts. A lot of people moved money into CDs. And when it comes due, there has to be a place to put it. And that is where a lot of money is going to be flowing back into the market. Bonds are not going to be as desirable. CD rates are slowly dwindling as we see across financial institutions, both banks and credit unions. The rates are starting to slowly go down, but we're also seeing decrease in rates in auto loan rates, personal lending rate. We're also seeing it in mortgage rates. They are starting to go down. And of course, as this continues, the bonds are going to slowly go down as well. Older bonds, as they come due, they don't have to pay quite as high of an interest rate. So what exactly does this mean for you and the bottom line? Changes in interest rate broadly influence the stock prices, bond interest rates, consumer business spending, and the state of the economy. It seems like at that 2.1% that we're seeing for the economy, we're in a very good spot. But like I said, with the rate reduction that we've seen of the 0.50, it takes roughly 12 months to feel the impact. So even going into 2025, we haven't felt the full impact of what this rate reduction has done for us. Overall, when it comes to investing, I stick by Warren Buffett, and I stick by it is the time in the market. It is not about timing the market. If you're trying to get in at the very low point and then selling at the very high point and going back and forth, it has been proven that time in the market, that no one can really time the market. You might get lucky once, but overall, trying to time the market is near impossible. It makes sense. Consistent contributions into the 401k plans, into those HSAs, into those IRA accounts are what is going to build wealth and really grow regardless of what the economy does. And honestly, if it starts pulling back, if the S&P 500 starts pulling back and we see a 20-30% decline next year, I will be super excited because I will be buying it the whole entire way. I utilize dollar cost averaging, meaning every single week I put $250 into the market, so $1,000 a month in my brokerage account, which of course is a taxable investment account, making my contributions on a regular basis. If it continues to go down, I will buy it all the way down. Then when it turns around and it starts coming up, I am going to be exponentially that much more ahead because I bought it at a very, very big discount. So all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.